As traders, we can make money by looking at price action, we can look at companies' earning reports, and we can look at news stories. We can also look at the economic calendar to see when certain announcements of economic data are going to be released. Data such as job reports, the Consumer Price Index, and when Federal Reserve meetings and announcements are taking place. All these things move the markets one way or the other, and it's our job to understand what they mean, so that we can take advantage and find opportunities to make some money. So let's see what it all means. Now this video is going to be split into two parts, as there is lots of information to take in, and I think we'll all earn a well-deserved break halfway through. So make sure to catch part 2 if you're still with me by the end of this episode. Now I'm going to go over a few major macroeconomic topics that are really important, especially at the moment, and I'll explain what each thing is, and then at the end I'll explain how we can use them to trade. Now, due to the pandemic and the way it has shaped consumer spending, commercial operation, and monetary policy over the past couple of years, our understanding of these topics is incredibly vital, not just to make money, but to protect our capital. And we do that by making informed and confident decisions. The direction that the markets move is directly impacted by these things, and they are the US Non Farm Payroll, the Consumer Price Index, the 10-year Treasury yield, inflation, and interest rates. Now, if we have a vague grasp of these things and keep an eye on them via the economic calendar, news articles, and by looking at benchmark indices such as the Dow Jones and the Nasdaq, then we can make better decisions on how and when we trade. You can keep track of what information is being released simply by Googling US economic calendar. So let's kick things off with the US Non-Farm Payroll, or jobs report. This is a monthly statistic showing how many people are employed in the US, excluding farmers, hence the non-farm bit. And this report comes out each month. There is also a jobless claims report that comes out weekly, giving the statistic of how many people filed for unemployment week by week. So you can use these reports to find an opportunity to place a trade based on the sentiment of the report. Sounds straightforward enough, but we need to have a good understanding of what this actually means economically. For instance, January's report came out a couple of weeks ago, and it was a total shock and a surprise to everyone, as it came in at triple what the expectations were. The White House warned that new employment numbers in January could be as low as 150,000 because of the Omicron wave, but in fact the amount of jobs added rocketed by almost 500,000 for the month. On top of this, wages grew at a very hot 5.7% over the year, which is the biggest increase in decades. Now all of this sounds fantastic. People are back in work and wages are up. But actually it's a sign that things are moving too fast too quickly. Because when we think about this logically, wages going up means higher labour costs for companies, which in turn forces those companies to put prices up, ultimately costing the customer more. Therefore the cost of living rises, and then employees start demanding higher wages again, and we find ourselves spiralling into a catch-22 web of inflation. Now, stay with me. We measure the rate of inflation by looking at the CPI, or the Consumer Price Index, which is also released every month, and it's generally regarded as a barometer of overall economic health. The CPI is a percentage that represents the difference in the cost of a basket of goods and services from month to month, showing the change in prices that consumers pay for things over time. The basket of goods they use to gauge the rate of inflation are intended to mimic the things a typical person would buy, such as food, clothing, transportation, recreation, medical care, and education. They look at what the basket costs this month compared to what it cost last month and work out the difference. And that gives an idea of how quickly the prices of things are increasing or inflating. Generally, a low annual CPI rate in the 2 to 3% range is what is aimed for. But from November to December last year, the CPI showed that inflation rose 0.5% in a month, bringing the annual rate to a 40-year high of 7%. Now yesterday, 1 hour before the market opened, the very important and highly anticipated January CPI data was released, and it came in at an annual rate of 7.5%. Now analysts were expecting a rise of just 7.2%. So this meant inflation was much hotter than expected. And so because of this, I confidently went in for a short position on the Nasdaq right as the news came out. You got to be quick, because as soon as data is released, the markets move immediately. So you need to have your platform open with access to your news source. Now, a good source of fast and up-to-date news and information is Walter Bloomberg's Twitter feed. So follow him and stay up to date. Now, I traded the Nasdaq because high inflation is most damaging to tech companies who rely on future profits and borrowed money. And so as the price tanked, I rode it all the way down to the first major support level and closed out 40 points worth £520 and a second position of £200. This hotter than expected CPI result wiped out almost 300 points off the Nasdaq and 400 points off the Dow in the space of an hour. And I had predicted that this would be the case if the CPI results came in hotter than expected. And so I took advantage thanks to a basic understanding of what the CPI is and what it means for the economy. Now, all that happened an hour before the market opened, and at 2:30 PM UK time, when the market officially opened, you would have been a fool to expect the price to have kept on dropping, because it did the exact opposite and almost completely recovered all the losses, thanks to a strong batch of earning reports. But this glimmer of optimism was merely a flash in the pan, as halfway through the session the market slid back down even further after a Fed official claimed that the central bank may move more drastically to curb inflation. And so at around 7:30 PM I went in for another short position on the Nasdaq, as I knew this had absolutely no chance of recovering whatsoever. I waited for the price to pull up to get my short entry into a good position, and then I confidently waited for the price to drop all the way back down to my take profit order of £1,000. What a day. Now, because of the rise in inflation due to the jobs growth and the boom in the economy, the Fed has to step in to slow things down a bit. And they do that by raising interest rates. Now, since the start of the pandemic, interest rates have been at almost zero to help soften the blow of the recession and to help stimulate the economy as the US went into lockdown. This made prices of stocks and cryptos surge, and the recession only ended up lasting a couple of months. Yet the interest rate level is still very low to this day. So at the end of January just gone, Fed Chairman Jerome Powell rather vaguely announced plans to raise interest rates very soon, possibly in March. And raising interest rates, which basically means increasing the amount it costs to borrow money, has the effect of slowing down economic activity, which, in theory, curbs inflation, but then obviously slows down economic growth as well. The problem is the fact that inflation has risen so much this year, by 7.5%, that the Feds need to act quickly before it really does damage to the economy, as the longer high inflation goes on for, the harder it is to rein it back in to meet their annual target of 2%. So the general expectation is for the Fed to start raising interest rates in March. But the question everyone is asking is by how much? Markets have been anticipating the Fed to hike interest rates at least 5 times this year. And what they usually do in situations like this is they increase the rate slowly by 25 basis points each time, or by 0.25%. But since the surprisingly outstanding jobs report this January and the hotter than expected CPI data, investors now believe the Fed are going to act more aggressively or hawkish and increase the rate in March by 50 basis points or 0.5%. Some even think they could now raise it by 100 basis points or 1% by July, which is way more brutal than investors were expecting, hence the huge drop in the markets yesterday. Now, a lot of investors worry that the Fed are behind the curve and have waited far too long before stepping in to curb inflation. Others believe the Fed will damage the economy if they hike rates too much and too fast. In the 1980s, even as high inflation was in decline, the Fed kept interest rates at around 20%, which ended up causing a recession. If the Feds increase the rates as they say they will do in March, it will still remain at an historically low level around 1%. So what do you think? Is the market overreacting? Now, I think that's a pretty good point for a break to let all that sink in before we get into the 10-year Treasury yield. So if you want, go back and rewatch some of this video, as it's all quite confusing and there's a lot to take in. But once you get into the swing of it, you'll find it's all actually pretty straightforward stuff. So join me in the next video where I'll be carrying straight on with the rest of the fascinating world of macroeconomics, and I'll be explaining how all this helps us as traders. So don't forget to like and subscribe, and I'll see you in the next video.